Ladies and gentlemen, we need to talk. Because something happened last night while you were sleeping, and if you don't understand what it really was, you're going to misread everything that comes next. When you opened your charts this morning, you didn't see a correction. You didn't see profit taking. You didn't see a healthy pullback. You saw a crime scene. Silver was trading confidently near $83. Then, without warning, it collapsed, straight down, no stair steps, no hesitation. In a matter of minutes, silver crashed to $73.72. That's a 14% drop, not over weeks, not over days, but in minutes. Moves like that don't just cause losses, they wipe out leveraged accounts, they force emotional selling, they convince intelligent people to abandon positions at the exact wrong moment. And here's the first truth you must lock into your mind. This was not a change in fundamentals. Silver did not suddenly become worthless at 2 a.m. Solar panels didn't stop needing silver. Industrial demand didn't disappear. Mines didn't magically refill. So if this wasn't fundamentals, what was it? It was mechanical. It was forced. It was an execution. And if you sold because you were scared, you didn't just lose money. You were caught inside a value-at-risk shock, also known as a V-shock. Before we go any further, you need to understand when this happened, because the clock explains everything.
This crash didn't happen when markets are active. It didn't happen during the New York Open. It didn't happen during the London Fix. It happened at exactly 2 a.m. Eastern Time. Now pause. Ask yourself a very simple question. Who is trading silver at 2 a.m. during the week between Christmas and New Year's? Retail investors? Asleep. European stackers? Midday, mostly physical buyers. Pension funds? Closed. Asset managers? On vacation. Institutional desks? Skeleton crews only. This week has a name on Wall Street. It's called Ghost Week. The screens are on. The market is technically open, but liquidity is gone. The order book is thin. The bid stack, the wall of buy orders that normally catches falling prices, is barely there. It's a hollow market, and hollow markets are dangerous because they don't absorb shock, they amplify it. And that is exactly when the trap was sprung. At approximately 2 a.m., a large institutional player, what we call a whale, ran into trouble. This wasn't a small loss. This wasn't bad timing. This was a catastrophic breach of maintenance margin. In the retail world, margin calls come with phone calls. In the institutional world, there are no phone calls, no negotiations, no mercy. When margin is breached, liquidation is automatic. And liquidation is not handled by a trader. It's handled by a risk engine, a machine, cold, unemotional, unforgiving. It has one instruction: get out immediately. It does not care about price. It does not care about technical levels. It does not care about fundamentals. Its only goal is to sell until the account is solvent or until the market breaks. At 2 a.m., that risk engine began firing market sell orders into silver. In a normal market, buyers would step in. The price might dip 50 cents, but this was not a normal market. There were no buyers, so the algorithm sold, and to find liquidity, it had to push price lower. $82, no bids. $80, still nothing. $78, buyers vanish, so it sold more. 76, 75, 74. This is called a liquidity cascade. It's like dropping a grand piano out of a skyscraper. It doesn't stop because it wants to. It stops when it hits something solid. And silver didn't find that floor until $73.72. That's where enough buyers finally appeared to clear the book. So when you see that massive red candle, do not read it as bearish sentiment. Read it as evidence, evidence that someone blew up. Here's the most important distinction most people miss. This selling was price agnostic. The seller did not want to sell at $73. They were forced to sell at $73. That difference changes everything. If investors sell because they believe silver is overvalued, that's bearish. If a machine sells because a leveraged gambler went bankrupt, that's bullish. Why? Because the weak hand is gone, the leverage is flushed, the overhang is removed, the whale is dead, and every ounce they dumped is now owned by someone stronger. But the damage didn't stop there, because that liquidation woke up a second, far more dangerous system.
The initial liquidation was only the spark. What turned a sharp drop into a violent crash was something most investors never see: dealer gamma. When silver broke through key levels, market makers found themselves trapped inside their own hedging models. They weren't choosing to sell, they were forced to sell. Banks sell options. To remain neutral, they hedge dynamically. As long as price moves slowly, this works, but when price moves fast enough, gamma flips negative. Negative gamma creates a feedback loop. Price drops, banks must sell to hedge. Selling pushes price lower, banks must sell more. This turns selling into a self-feeding spiral. Algorithms chasing algorithms, risk models cannibalizing the market. This is why silver didn't drift lower, it collapsed. And this spiral should not have stopped. Mathematically, price should have gone much lower, but it didn't. Which brings us to the real story. If the order book was empty, if negative gamma was active, why didn't silver go to $60? Why didn't it go to $50? Why didn't it go to zero? Because the plumber arrived. At approximately 3:15 a.m., alarms were flashing across the financial system. Clearinghouses faced potential default. Counterparty risk exploded. Banks stopped trusting each other. The repo market froze. And when that happens, the entire system is at risk. So the fire hose turned on. $34 billion was injected into the overnight repo market. This was not stimulus. This was not easing. This was emergency surgery. The Fed didn't save silver. They saved the plumbing. That injection stabilized the bid stack. It allowed market makers to quote prices again. Without it, markets would have halted. Silver didn't find support. It found the Fed put. Think about the absurdity of this. A metal, an element, required a $34 billion bailout just to keep trading. Not because silver is rare, but because paper leverage is extreme. The system is hollow, and it nearly broke. But here's the key point. The Fed fixed the paper problem. They did not fix the physical one. They printed dollars. They did not print silver. And while Wall Street was panicking, the rest of the world was watching. While New York collapsed, Shanghai didn't care. Silver in China held near $89 per ounce. West, $75. East, $89. A $14 spread. That is not normal. That is a broken market. In a functioning market, that spread would vanish instantly. Buy at $75, sell at $89. But traders can't. Export licenses, physical restrictions, metal trapped in China. Two worlds, paper in the West, physical in the East. Before the crash even happened, something important occurred. Over 600,000 ounces of silver were withdrawn from COMEX vaults. That's not panic, that's preparation. Smart money didn't sell, they removed metal. They don't trust the price, they trust scarcity. Turn on the headlines, they blame retail investors. They call it panic selling. But the data says the opposite. ETF inflows increased. Bullion dealer traffic exploded. Retail bought the dip. The only sellers were forced institutional liquidations. The media needs a scapegoat. They cannot admit the system broke. The leverage is gone. The weak hands are out. The physical market is tight. And in days, institutional desks return. They will see a $14 discount. They will see a generational setup. This was not a warning, it was a flush. The slingshot is loaded. The trap failed. Now comes the chase.